Welcome to Joseph Markets, your go-to channel for insightful finance discussions powered by cutting-edge AI analysis. Today, we're diving deep into a topic that's transforming the cryptocurrency landscape: how institutional money moves Bitcoin. If you're new here, hit that subscribe button and turn on notifications so you never miss out on our breakdowns of market movers, investment strategies, and the forces driving financial innovation. And if you appreciate 100% verified, fact-based content like this, sourced from reliable reports and data, give this video a like, drop a comment saying, Joseph Markets, and let's build this community together. Your engagement helps us deliver more accurate, in-depth advice tailored for savvy investors like you. This video key insights on institutional influence in Bitcoin research suggests that institutional investors, such as asset managers and corporations, have increasingly viewed Bitcoin as a diversification tool and hedge against inflation, driving significant price appreciation through regulated vehicles like ETFs. It seems likely that major inflows from institutions, including BlackRock and MicroStrategy, contribute to reduced volatility and deeper liquidity in Bitcoin markets, though sharp swings can still occur during economic stress. Evidence leans toward institutional adoption accelerating since 2024's spot ETF approvals, with allocations often ranging from 1 to 5% of portfolios, potentially pushing Bitcoin toward mainstream asset status amid evolving regulations. Understanding institutional money in Bitcoin. Institutional money refers to large-scale investments from organizations like pension funds, hedge funds, banks, and corporations. These entities manage trillions in assets and approach Bitcoin with structured strategies, often using regulated products to mitigate risks. For instance, spot Bitcoin ETFs have attracted over $100 billion in assets under management, providing a gateway for conservative investors. Mechanisms of market movement. Institutions move Bitcoin prices through massive capital flows. Inflows during bullish sentiment can propel prices upward, as seen with ETF net inflows exceeding $20 billion in 2025, while outflows during risk-off periods may amplify downturns. Their participation enhances market efficiency, but introduces correlations with traditional assets like stocks. Recent examples and trends. Companies like MicroStrategy hold over 600,000 BTC as a treasury reserve, signaling long-term confidence. In 2026, with clearer regulations like the EU's MiCA, institutions are expected to allocate more, potentially stabilizing prices while fostering innovation in tokenized assets. Future considerations. While institutional involvement legitimizes Bitcoin, challenges like regulatory uncertainty and security concerns persist. Investors should monitor sources like EY surveys for balanced views on scaling allocations. Imagine this. You're watching the Bitcoin price chart, and suddenly it spikes 10% in a single day. Retail traders celebrate or panic, but behind the scenes, it's not just everyday folks buying dips. It's massive institutions with billions at stake quietly shifting the entire market. What if I told you that these big players aren't gambling? They're strategically positioning Bitcoin as a core asset in their portfolios. Stick around because in the next 30-40 minutes, we'll unpack exactly how institutional money enters, exits, and ultimately moves Bitcoin's price. We'll cover the history, the mechanics, real-world examples, and even the risks, all backed by credible sources. By the end, you'll understand why Bitcoin isn't just digital gold. It's becoming institutional gold. And remember, for more on how to navigate these shifts, like, subscribe, and comment. Joseph Markets below. Let's start with the basics. What exactly is institutional money, and why does it matter for Bitcoin? Institutional money comes from large organizations like pension funds, hedge funds, asset management firms, banks, and even governments. These aren't your average investors trading on apps like Robinhood. They're managing trillions of dollars globally and make decisions based on rigorous analysis, risk models, and long-term goals. According to a 2025 report from State Street Global Advisors, SSGA, institutions are embracing Bitcoin for its potential in diversification, long-term growth, and as a hedge against currency debasement. They note that 94% of institutional investors believe in the long-term value of blockchain technology and digital assets, which underpins Bitcoin's appeal. Why Bitcoin specifically? Bitcoin dominates the crypto market with about 65% of the global crypto market cap, standing at around 1.65 trillion as of November 2025, per SSGA data. Its scarcity, capped at 21 million coins, makes it attractive in an era of fiat money printing. Institutions see it as a store of value similar to gold but with digital advantages like easy transferability and divisibility. But here's the hook. Unlike retail investors who might buy on hype, institutions use sophisticated tools to enter the market, and their moves can create waves that last weeks or months. For example, when institutions pour in during bullish cycles, prices soar. When they pull back, volatility spikes. We'll explore how this happens step by step. First, let's trace the history of institutional adoption. It wasn't always like this. Bitcoin started as a fringe asset for tech enthusiasts and libertarians back in 2009, but fast forward to 2020, and things began to change. According to a timeline from Insights 4VC, in 2020, the U.S. Office of the Comptroller of the Currency, OCC, clarified that banks could custody crypto assets, paving the way for major players. That year, companies like MicroStrategy and Square, now Block, made headline-grabbing Bitcoin purchases as treasury reserves. MicroStrategy, in particular, bought Bitcoin as a hedge against inflation, setting a trend. By 2021, the floodgates opened wider. Tesla invested $1.5 billion in Bitcoin, and Coinbase went public via IPO on Nasdaq. Investment banks like Goldman Sachs restarted their crypto trading desks, and Morgan Stanley offered Bitcoin funds to wealthy clients. The launch of the first U.S. Bitcoin futures ETF, ProShares BITO, in October 2021 gave institutions a regulated way to gain exposure without holding the asset directly. According to Chainalysis data from 2020, high-value transfers from exchanges increased by 19% when Bitcoin was above $10,000 compared to 2017, signaling growing institutional activity. The bear market of 2022 tested this resolve, but institutions built infrastructure instead of fleeing. BlackRock partnered with Coinbase for institutional crypto trading and launched a private Bitcoin trust. JP Morgan's Onyx division processed billions in payments using JPM Coin, experimenting with tokenized assets. According to EY's 2025 Global Institutional Investor Digital Assets Survey, even during downturns, 60% of institutions maintained allocations above 1% to digital assets, showing resilience. Then came the game changer in 2023 and 2024, regulatory progress. BlackRock filed for a spot Bitcoin ETF in mid-2023, followed by Fidelity and others. The SEC approved spot Bitcoin ETFs in January 2024 and Ether ETFs soon after. This unlocked billions from pensions and registered investment advisors, RIAs, who couldn't hold crypto directly before. By early 2025, institutions held about 15% of Bitcoin's supply, per Insights 4VC. Spot ETFs saw massive inflows, broadening participation and legitimizing Bitcoin. In 2025, adoption accelerated. U.S. spot Bitcoin ETFs netted $21.3 billion in inflows, according to Daic Capital. Corporate treasuries ballooned to over 200 firms holding 1.1 million BTC, 5.5% of total supply, worth around $100 billion. MicroStrategy, rebranded as Strategy, amassed 672,500 BTC, adding 226,100 that year alone. Globally, Japan and China dominated non-U.S. holdings. Pension funds in the UK reported 56% annual returns on 3% Bitcoin allocations, outperforming traditional assets like gold and stocks. Now, in 2026, we're seeing normalization. According to Interactive Brokers analysis, crypto has shifted from speculative to institutional portfolio allocation. Ownership is consolidating. 19.4% of Bitcoin supply is held by ETPs, 7.2%, public companies, 5.3%, governments, 3.1%, and others. Regulations like the EU's MiCA and stablecoin frameworks in Singapore are filters that concentrate capital into compliant assets. This history shows institutional money didn't just arrive, it evolved, turning Bitcoin from a niche experiment into a portfolio staple. But how do institutions actually invest? They don't just buy Bitcoin on retail exchanges. They use regulated, efficient channels to minimize risks. Let's break it down point by point. Point 1. Spot Bitcoin ETFs. These are the easiest entry point. ETFs like those from BlackRock and Fidelity allow institutions to gain Bitcoin exposure through familiar stock-like products traded on exchanges. According to SSGA, the US BTC ETF market grew to $103 billion in AUM by 2025, with institutional share at 24.5%. 60% of investors prefer these registered vehicles. When institutions buy ETF shares, the issuers purchase actual Bitcoin, driving up demand and prices. For instance, CryptoQuant reported that large custody wallets accumulated $53 billion in Bitcoin over 12 months in 2025-2026, including ETF contributions. Point 2. Futures contracts. Platforms like the Chicago Mercantile Exchange, CME, offer Bitcoin futures, letting institutions bet on price without owning the asset. This is great for hedging. AllTrade notes that futures and ETFs have deepened liquidity, making markets less prone to extreme swings. Point 3. Direct holdings and custody. Bold institutions buy Bitcoin outright and store it with custodians like BNY Mellon or Coinbase Custody. EY's survey shows 35% of institutions allocate 1.5% to spot cryptocurrencies, with Bitcoin leading. Companies like Metaplanet added 4,279 BTC in Q4 2025 for $451 million per Yahoo Finance, bringing holdings to 35,102 BTC. Point 4. Tokenized assets and derivatives. Institutions are tokenizing real-world assets, RWAs, on blockchains, integrating Bitcoin into broader finance. 57% of EY respondents are interested in tokenized assets like private funds or bonds. BlackRock's BUIDL Fund, a tokenized U.S. Treasuries money market, exemplifies this. Point 5. Over-the-counter, OTC trading. For large trades, institutions use OTC desks to avoid slipping prices on public exchanges. This discrete method moves massive volumes without immediate market impact. Point 6. Staking and yield strategies. While Bitcoin itself doesn't stake, institutions use lending platforms for yields. FinTech Weekly highlights over-collateralized lending and arbitrage, generating returns exceeding fixed income benchmarks. These methods ensure institutional money flows efficiently, but their scale amplifies effects. For example, when BlackRock buys Ethereum, related but indicative, it signals confidence that spills over to Bitcoin. Now, the core question: how does this money actually move Bitcoin's price? It's all about supply, demand, and market dynamics. Let's explore in detail. First, inflows and accumulation. When institutions accumulate, they reduce available supply, pushing prices up. CryptoQuant data shows wallets holding 1,000 BTC accumulating despite price crashes, indicating strong demand. In January 2026, ETFs saw 697 million in net inflows on a single day. According to Anthony Pompliano in a Benzinga interview, institutional participation beyond ETFs, corporate treasuries, and sovereign wealth could drive Bitcoin to $1 million as they focus on long-term value. Second, outflows and sell pressure. Conversely, when institutions sell, prices drop. But they're strategic. They sell during highs or rebalance portfolios. AllTrade explains that institutional adoption has reduced volatility to 35 to 40%, akin to tech stocks, but risk-off events still cause corrections. Third, liquidity enhancement. Institutions bring deeper markets. EY notes allocations increasing liquidity for tokenized assets, which indirectly benefits Bitcoin by integrating it into finance. Fourth, correlation with traditional markets. A paper from Copestake et al., 2024, shows institutional participation co-moves with Bitcoin's correlation to equities. Post-2020, Bitcoin reacts more to monetary policy, like U.S. rate hikes, due to shared investors. Fifth, network effects and sentiment. Large buys signal legitimacy, attracting more capital. DIC Capital highlights how ETF approvals made Bitcoin a top 10 asset by market cap at $1.8 trillion in 2025. Sixth, volatility compression. Interactive Brokers data shows small Bitcoin allocations improve portfolio Sharpe ratios, encouraging more entry and stabilizing prices. But who are the key players? BlackRock leads with spot ETFs and trusts. Fidelity offers digital units. MicroStrategy holds 687,410 BTC as of early 2026 per Yahoo. Metaplanet aims for 210,000 BTC by 2027. Governments like the US hold 325,000 seized BTC as reserves. Banks, BNY Mellon custodies, JP Morgan experiments with tokenization. Recent trends? In 2026, staking turns crypto income producing. Solana and Ethereum yield, but Bitcoin benefits from ecosystem growth. X posts highlight ongoing inflows. One from Quantum Expeditions notes, institutions care about long-term impact, not short-term prices. Another from Crypto University warns big money doesn't guarantee immediate movement, echoing ETF experiences. Risks. Regulatory uncertainty tops EY's list. Security. DAC notes, 25–33% of BTC vulnerable to quantum threats. Volatility persists, but rewards outweigh for many. Looking ahead, institutions will drive Bitcoin's maturity. Pompliano sees sovereign wealth pushing prices higher. Interactive Brokers predicts systematic allocations becoming standard. That's our deep dive. If this helped, like, subscribe, and comment Joseph Markets. Stay tuned for more.